Housing's a leading indicator, and it was actually turning in the quarters before COVID hit. And it was just starting to come around because the Fed had lowered rates in 2019. And of course, we're seeing a big rebound now. It's unclear if this is going to be sustainable. We're up about 8.7% year over year based on today's data. And we're almost back to February's pre-crisis levels in terms of existing home sales and in terms of housing starts to address the issue with supply, right? So certainly low interest rates really help with that. And we're seeing a lot of people at home, right? They're reevaluating their home environment. So that is spurring a lot of purchases of both new and existing homes.
Yeah.
And so we really think of it as FOMO versus FOGO. FOMO, fear of missing out, and FOGO, fear of going out. All the FOGO aspects of our nature are driving the economy and the stock market right now.
Yeah, fair enough. And Katerina, I'll ask you if all of this is already priced in. I mean, especially in the housing sector, we've talked about the massive runs in Home Depot and Lowe's in the home builders. But does it give you more confidence in the stock market overall, or are you still concerned that things there have just gotten too stretched?
Kelly, thank you for having me on the show. I agree with Constance. I think that the housing markets is a very positive development. This run-up that we're seeing certainly points to the improved consumer confidence. And as we're looking at economies continue to reopen and just overall this V-shaped recovery, which we're thrilled about, but we still can't discount the fact that the economy is not fully recovered yet, and we still are facing the uncertainty of the upcoming election. We're facing the things that we're focused on, leading up to the fall, like trade tensions with China and continued threat of the virus and the absence of the vaccine. So, having said all of that, we are expecting heightened volatility for the months to come. But this is certainly seen as positive development.
You guys basically, Katerina, have three recommendations. You think people should get into cheaper segments of the market to benefit from the next leg up, so mid caps, maybe global equities, some value names. The themes like Constance was describing that are accelerated by COVID-19, so that's 5G, the digital transformation and so forth. But you're also recommending some defensive plays like gold, like long duration treasuries. You think there's still value to be had there?
Absolutely. Specifically to investors that feel that they've missed the rally. We think that there's still time to get in as long as they do it strategically and defensively and hedge their portfolios with the defensive plays like gold, like long duration treasuries, just like you said. Because the reason for this is, as I mentioned earlier, we're expecting a lot of volatility, but we also expect that there is going to be a lot of buying opportunities as we see them right now in sectors that have not benefited from the next leg up. And as tempting as it is to be buying high flyers, we are encouraging investors not to fall into this all this time trap of buying high and selling low. And instead, we ask them to be defensive, to be strategic, and as a matter of fact, use this time to rebalance their portfolios, which will be extremely.
It sounds